Good morning. It's Thursday, the 17th of October, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital, where it mercifully did not rain last evening. And the top stories and themes for the day. The stock markets fall further as queues disappear. Hyundai Motors IPO is in second gear. Why India's 11-month market rally is at risk. And rewriting the Income Tax Act 1961, the latest three-part takes.
This is a core report with Govindraj Ethiraj.
The stock markets are missing cues. Foreign investors have been selling every day of the month till Monday, October 14th, turning into net sellers. Bloomberg says the sales are on track for the biggest monthly outflow since the height of the pandemic in March 2020. The reasons are along the lines of what we've been discussing, a shift in investments to China as investors race there to ride the momentum there, and of course, what could be valuation fatigue here. More on that shortly. While Wall Street was set to be flat on Wednesday overnight after hitting record highs on Monday, back home the BSE Sensex and the NSE Nifty 50 stayed subdued, with the Sensex falling about 318 points to close at 81,501, while the Nifty 50 ended at 24,971, down 86 points. Not surprisingly, only because we are not surprised anymore, the Nifty Small 100 closed marginally positive, though the Nifty Mid Cap 100 index was down very slightly by about 0.2%. Hyundai is in second gear. Meanwhile, Hyundai Motors IPO is still struggling to gather speed and is mostly on to stick with automotive analogies between first and second gear, or at best second to third. Its IPO received a 42% subscription on the second day of bidding on October 16th, according to Money Control, quoting NSE or National Stock Exchange data at 3 p.m. on Wednesday. The portion for retail investors of that 27,870 crores, almost 28,000 crore mega IPO, if I might add, was subscribed about 38%, while the non-institutional investor category was at about 26%. Qualified institutional buyers was about 58%. Only the employee portion has been fully oversubscribed, which in some ways is a good sign. The company on Monday raised 8,300 crores from anchor investors. Now, most other initial public offers would have been fully subscribed by now. That's going into day two, given trends in recent months or year. But that's, of course, if they were smaller and priced less. Remember, many of the smaller retail investors go by absolute price and small lots, particularly if they're punting for listing day gains. And since the price here is around 1,900 per share, that makes it a little difficult. Deciphering the market signals. The stock markets are not transmitting clear signals at this point, likely because there are no fundamental or technical or sentiment signals that they can really ride on. A Bloomberg report says that the run in the markets is now at risk, with companies forecast to report slowing profit growth. Brokerages are predicting that companies in the NSE Nifty index will either report flat or low single-digit profit gains for the quarter ended September. Earnings may expand at the slowest pace in more than 4 years, Jefferies, a stockbroker, said in their coverage universe, which excludes oil and gas, quoted once again by Bloomberg. The indices have dropped about 3% in October, paring the year's gains to about 15%. But the earnings slowdown is being driven by weakening consumer spending and increasing commodity prices, Bloomberg said, quoting an analyst saying that there is a visible loss in macro momentum. Other analysts at Sanford Bernstein and Macquarie Capital Securities concurred, and the MSCI India Index is now down 2.6% in October, following a record 11-month winning run. Now, there are other factors reflecting slowing growth, which includes slower goods and service tax collection to passenger vehicle sales, which have either slowed down or fallen. Both manufacturing and services purchasing managers index or indices, that's PMI, have also dropped. The recent second quarter results also seem to drive home the point, with both Reliance Industries and Tata Consultancy Services, very different sets of businesses, but in both cases, their net incomes falling short of estimates. Bloomberg said that the MSCI India gauge is now trading at a valuation of almost 24 times its 12-month forward earnings versus a 5-year average of about 21, adding that that is also more than double the multiple for the MSCI China index. So you can see why people are racing there. I reached out to Andrew Holland, Mumbai-based CEO at Avendus Capital Alternate Strategies, and I began by asking him how he was seeing the markets right now and his prognosis for the next few months.
Just prior to that kind of China move, it was all so easy for India, right? No one liked China. all the reports I was getting from, brokers traveling. There's that, the investors saying, don't talk to me about China, only talk to me about India. And, with the domestic flows, everything was hunky-dory, right? Nothing could nothing could really change. And obviously with the Federal Reserve coming down with, bringing down interest rates, that was the extra kind of impetus. But then China came along and, did a big stimulus. And I think what happened initially, as you kind of alluded to, were kind of caught unaware in terms of, they were skeptical about any kind of decision from China. So when that came about, they had to scramble. They had to get exposure as quickly as they could. Now, money hadn't really flowed into emerging market funds, so they didn't have that kind of cash to move around. So they had to find an avenue for that. So India became the avenue. So they took money off the table in India and put it towards China. They can't miss out on a big rally because obviously they'd start to lose their own funds as well. I think going forward, we're still expecting more stimulus from China. But, say an emerging market fund gets $100. We know the weightage of India and China is about the same, around 23%. So they might do 25% China and they might do 10 or 11 or 12 for India. So we'll still get some flows. It's not bad news, but obviously not the flows that I think prior to China's stimulus that everyone was expecting was just, it was too easy. So we have that. And of course, you have the challenge of valuations in India. And we have the challenge now of the earnings season, which I think will be quite poor. So, you have those factors, and there's many other factors as well, which makes me more cautious towards negative on the markets at the moment.
And earnings is a good point because we've already seen some earnings come out and they have disappointed. Two questions there. One is, to what extent is the market predicating itself on earnings? Because that's, of course, what many fund managers have been saying. And the second is, was this not expected? Let's say the more negative or the disappointing earnings relative to street that we've seen in the second quarter.
See, I think a number of things the market was banking on. They're not alone in that. After the elections, you're expecting this pickup in capex by the government, followed then by private capex, which will start to kind of have a multiplier effect, and then obviously positive impact onto earnings going into the second half of the year of our fiscal year. Now that's just not happening, and you're not seeing that rural growth that everyone was talking about starting to really kind of move through in some force, which is helping companies as well. So that 15% earnings growth that we're all expecting is probably now looking nearer to 10. Now, and if you're not getting any uplift in the second half of the year, which is not likely at this point, then your valuation is baking in a 15 to 20% earnings growth. So something will have to change, and I don't think it's earnings that is going to change. So I think valuations will have to come down, and there's many other factors. Listen, we can keep talking about domestic flows, but the actual amount of issuance that we're seeing in IPOs, block trades, QIPs. It's starting to kind of really ease into that kind of domestic flow now. And you're starting to see at the edges domestic flow starting to slow, not in SIPs, but in terms of just new money going into mutual funds.
So you're saying demand is catching up with supply? Andrew, let me pick up on the flows. So are we saying that now supply in some ways is catching up with demand or demand with supply? And because earlier it seems to be so supply driven.
I look at it from, you have money flows into mutual funds, and then you have obviously the supply of paper from companies and management. And that really is starting to kind of eat into that kind of big pile of flows that we're seeing every month in the mutual funds. And of course, then if you have FII selling so aggressively, it means that there's little, headroom for the markets to move up. And there's no one particular sector which is kind of driving the market now. We thought it would be banks because, if you think about the interest rate cycle in the US, we thought maybe the RBI might have that wiggle room to do something in October, definitely in December. But of course, what happened in the Middle East could have allayed that kind of expectation for October. So the banks are still pressurized under, their NIMs. And of course, the growth is not picking up for them. So you have that double whammy, that a great, sector, which is probably the better valued, doesn't have the growth.
If one were to follow through on the sector themes, what then is looking promising at this point of time and in the near term or near to medium term?
So, we've been fairly consistent in the kind of themes that we like to play. That's not just a shorter term theme, but, defense spending is definitely going to continue, right? That's not going to go away globally or for India. Renewable energy is not going to go away from us. So those, you will continue to see contracts being, given out. Railways would be the same. But, the themes that I like is premiumization. I think that's happening across many different sectors, but particularly in kind of non-alcoholic and alcoholic drinks. And I think that's the kind of, area that we've been focusing on. It's very early stages. We have a very young population. If I go downstairs, it's coffee I probably wouldn't have paid for, 2-3 years back, but I'm paying an enormous amount now. So, but that, that's the way it is, and that's the way it's going to continue. So we like that sector, premiumization in terms of the alcohol and non-alcoholic beverages. We like the kind of leisure industry. We think people continue to travel. Since COVID, we've seen that, but it's more about experiences now. It's not just, I want an experience as well when I go there. So spending a lot more money on travel and entertainment. So hotels, airlines fit into that. And then the electronic manufacturing sector, which I think, again, if you take an aeroplane, it's probably still in the hangar. It still has to come out towards the runway. It's a long runway for this sector. It's a bit like going back to where the telecom sector was at the very beginning of the kind of 90s, and you've got that long runway there. So those are the kind of sectors, we like. And there's kind of pockets of industries that you look at more evaluation. So maybe chemicals could be something that we'd look at again, but it's more valuation rather. We think it's a big theme that we want to play in the future.
And you talked about earnings, and my question really is about looking ahead for, let's say, the 2 quarters now. I mean, not just the current one or the one ahead. Do you see any sort of rebound, turnaround in some sectors maybe, or are you generally wary about the whole market or the entire sort of Nifty 50 kind of portfolio?
No, I'm worried about the whole market at the moment because valuations are not supporting the kind of, expectations that the market has. So that has to be tempered down. And, we haven't really talked about the US elections, but, and I think, reading as we all do that, it might be former President Trump that comes in. I just think about on the positive side for equities, he's going to cut interest rates, corporate tax. On the negative side, he's going to increase tariffs so hugely. It's going to have a big impact globally. It's going to have an impact on inflation in the US. It's going to have an impact on GDP slowing down in the US. Yes, interest rates might fall in the US because you're then chasing an economy which is slowing very quickly. But your long end of the bond yield curve might still remain very high because your fiscal deficit is going to be really hurting you. And that leads to credit problems, in the US. And that's a big whammy that we don't want to see. So I'm quite negative between now and January globally. And I don't think, whilst we can say it is a defensive market, our exports would fall. Interest rates might not come down as quickly as we were hoping for. So there'll be lots of problems, and valuations don't support that type of scenario. And I haven't talked about the Middle East. If a oil price was to go to 100, that would send shivers across the world.
Andrew, thank you so much for joining me.
My pleasure.
India's new tax code and the core report continues to weigh in. The government has invited suggestions on the Income Tax Act 1961 from the private sector and tax experts starting this month as part of an exercise to simplify the direct tax law. The objective is to simplify the language and reduce litigation. The finance minister in 24-25's budget that was presented in July had proposed that the review of that income tax law would be completed in 6 months, and that 6-month period would end in January. And it's also expected that an amended act would be brought into the budget session of Parliament. The core report is doing its bit to contribute to the discussion on the direct tax code by asking tax experts across the country for the 3 things they would like to see or not see in the new tax code. In the second installment of this series, I reached out to Dwarak Narasimhan, partner at Waterhouse and Company LLP. I began by asking him to list out his 3 asks.
Thanks, Govind. Thanks for having me on this podcast. And you certainly made my life a little difficult asking for just 3 items, considering they're planning to rewrite the entire tax code. But just as a starting point, right, just to set the context, the current tax law is over 60 years old, and I think it has been crying for an overhaul. The main reason is it's just been through so many twists and changes with court rulings and other legislative changes. At this point in time, it's unrecognizable from the law as it was initially written way back in 1961. It's also important that the government reviews this with a view to make it more current and make it in keeping with its own policy objectives, economic agenda, and what we're seeing globally. So with that in mind, if I were to pick sort of 3 items which I would like the government to really focus on, first and foremost, close to the hearts of many corporates as well as non-corporates would be ease of doing business. Again, just picking from ease of doing business, I'll pick 2 items, right? One, if you look at the whole concept of tax deduction and tax collection at source, you have a plethora of rates, variety of different sections. It applies on so many different kinds of payments and receipts. I think a simplification of the entire TDS and TCS provisions, maybe applying a uniform rate, taking away TDS or TCS on certain transactions, that would be a pretty good thing that the government could do. Second, there has to be some sort of thought process given in regards to consolidation of businesses. More and more, you are seeing businesses consolidating, businesses selling off, businesses becoming global and requiring to restructure. There are gaps in the tax law in regard to how the consolidation of those businesses can be treated. For example, when you do a merger, can that merger be treated as, first of all, can you do a merger irrespective of the kinds of entities which are involved? When there are different kinds of entities involved, can you treat those as tax-free? Can they be treated as tax-free not only for the entities which are involved, but also at the shareholder level? So things like that, a comprehensive law to address business restructuring, mergers, demergers, and such like would be extremely helpful. Third, some form of group taxation that could be introduced will be very helpful for large corporates. We are seeing more and more Indian companies expanding. You have perhaps special purpose vehicles which are set up. So some form of tax consolidation which will allow companies to ensure that they are able to offset losses incurred in, say, one line of business against profits in another line of business would be helpful. So from an ease of doing business, I think these would be 2 or 3 top of the mind issues that the government can address. The second area which I'd like to talk about is the Make in India initiative. Again, the government stated initiative. I mean, the government's goals are pretty clear in terms of empowering Make in India. What can we do from a tax reform standpoint to make that a reality? 2 aspects come to mind. One, of course, the rate of tax for manufacturing companies, which was reduced to 15%, but with various conditions. The government should consider making that a permanent 15% rate for manufacturing, and they should apply that irrespective of the form of entity you use for manufacturing. Second, there has to be a lot of thought given with regard to intellectual property. If you really want to make India a powerhouse, we need to spend time incentivizing the creation of intellectual property. So what can the government do? You could introduce a stronger patent box regime, which would encourage companies to house their IP in India. You could reduce the rate of withholding on royalty payments that India makes or Indian companies make so that it entices companies to use that IP, bring it and apply it in India. Third, you could introduce some sort of a weighted deduction for companies which invest heavily in R&D. That would incentivize them to spend that money, get a deduction, because obviously sometimes that R&D does not result in anything tangible at the end of all those years. So from a Make in India standpoint, I think these 2 initiatives, one on the tax rate and second on... And finally, I think I must touch on litigation, right? Again, it has been a flashpoint for so many different corporates across a number of years. The government must relook at overhauling the entire advance ruling process. The process initially, as envisioned several decades ago when it started off, was excellent. Somewhere along the line, we lost the plot. So I think relooking at the advance ruling mechanism, making sure that you provide certainty to taxpayers would be important. The other aspect is perhaps come up with some sort of a charter, a citizen's charter, if you will, and one which is pretty strong, which allows taxpayers some sort of a redressal mechanism, especially since we tend to see a lot of time the tax officials take decisions which are not only contrary to court rulings, but even different in different regions, depending on circumstances. So I think some sort of a sanity in that process, perhaps by way of a taxpayer charter, would be helpful. So, Govind, I think these are the sort of the three buckets, ease of doing business, Make in India, and litigation, that I think it'll be good if the government were to look at.
Most of what you're saying, or actually some part of what you're saying, lies outside the code itself, including, let's say, the part to do with rulings and so on. Would that be right?
Well, it is currently in the income tax law itself. So I think we should put it within the income tax law. The framework should be brought into the income tax law itself.
Okay. And things like citizen charter are obviously outside. I mean, that's something that you're saying is, yeah. Okay. Is there anything that you feel has outlived its existence completely?
Well, yeah, I think there's a number of provisions which I think the government should really do away with, right? If you look at things like the SEZ or the EOU or the STPI regimes, all those are now over. So it doesn't make sense to continue with them. They should certainly not find their way into the new tax code. You can have some sort of a savings mechanism in the old tax law so that any assessments, etc., can continue. So that's something in terms of repealing or pulling out stuff. But equally, I think the government must think about a tax law for the new age, right? You're seeing new business models. You're seeing new types of entities which are coming up. You're seeing businesses going global. Another example, there are onerous compliance requirements for non-residents that have transactions with India. That may really not be required, right? You need to enable trade between India and other countries, and that's not going to happen by imposing onerous compliance burdens. So I think one aspect is taking out some things which are not required, but the other thing is making sure it's progressive as well.
Is there an example of an industry or a sector where you feel is an illustration which says, okay, if you have laws which can meet this industry's needs and requirements, then we would have really reached somewhere, or encouraged such an industry or sector to thrive, then we would have reached somewhere?
I'll answer that question a little differently, Govind. I think, again, if you look at the last 30, 40 years, there have been various economic trends which different countries have benefited from, right? Some countries have benefited from manufacturing. India, to a degree, has benefited from services. I think we need to be future looking. For example, if we believe that space exploration or space companies are going to be the next generation of companies, you have artificial intelligence, Gen AI kind of businesses, then you need to have laws which enable and incentivize those kind of businesses to set up and flourish in India. So that's how I would answer your question.
Yeah, and I think that's a good response to that specific question as well. Thank you so much for joining me.
Thanks, Govind. My pleasure.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.